Good day to all. This is our second part for our discussions involving property, plant, and equipment still on initial recognition and measurement. Again, that is the first time recognition of such to our records up to the financial statements and so on. So we stopped at land last time. Now we will continue with building. We have to take note that land is under property while plant is under, of course, here, still part of PPE, but building. Then we have our items for the costs. So let's proceed. We have number one, purchase price. That includes other necessary costs, such as brokers' commissions and legal fees. So same as land in part 1A. Then number two, that's the same as well as numbers 3, 4, and 5. Let me focus with number 6, wherein if, for example, there will be cost of remodeling, renovation, and all repairs, which are there prior to occupancy, which is the stage already of occupancy as being ready for the building's intended use. Therefore, we have to capitalize. But if it is like during occupancy already, then there will be items that we have to take note, which will be tackled later. Could be in the other parts as well. So that's also part of the cost of a purchased building. In addition to that, the building also can be self-constructed. So this is when we are going to hire the services of construction companies in which such will construct building on our behalf or for us with payment. The said payments will cover the cost of the self-constructed building. So we have the usual items for the product costs of any product. Of course, we have direct materials, direct labor, and factory overhead. Then in terms of the plans for the buildings, so architectural costs, supervision, and the cost of building permit included, excavation for the foundation of the building to be included, insurance, safety inspection fees included as well. Then, for example, if there are some temporary structures that are built for the construction or for that purpose, like the shed of the workers, like the temporary fence surrounding the building, temporary, for example, like towers or let's just say framework or braces, okay, included as well. The number 6 will be the interest on borrowings made to finance construction, which will be tackled in another chapter. But the focus of this one is when a certain entity will borrow money, the purpose is of which for the construction of the building. Then continuation, the following are not to be included as cost of a self-constructed building. So we have, for example, let's say there would be savings because we self-constructed the asset. An example of this one is, for example, assuming that if we are going to purchase a building, the value is 15 million pesos. But if we do self-construction, we'll just pay 10 million pesos. So it seems that there is saving because we decided to construct the building 10 million versus the purchase price of 15 million. However, remember in financial accounting and reporting, we only record the actual costs of 10 million. No savings, internally speaking, shall be incorporated. And in that case, we have to focus again with financial accounting and reporting because this is our course. But that savings could be incorporated in another discipline, which is management accounting or another branch or area of accounting. Next, number 2, what about if because of inefficiencies, then such resulted to abnormal amounts of waste, material labor, or other resources? So in that case, guys, we have to expense that immediately because that is already beyond what is considered normal, again, abnormal. So in discussions in cost accounting, remember for normal waste, then we are going to consider that as part of the cost of the product, which is also true here because the normal waste actually is there or would be present even in the most effective conditions. But then abnormal would be already, since that is beyond what is considered as allowable. Then number three, for cost of uninsured hazards or claims for uninsured accidents, so expense immediately. Then number four, let's say we have private driveways, walks, permanent fences, parking lots, drainages, and water systems, which are not or that are not included in the building's blueprint. So not part of the plan, original plan of the building. So in that case, that will be, of course, not included as cost of the building. So they could be part of land improvements. Next, another improvement is the so-called building improvement, wherein it's, of course, part of the building, but it is not part of the original blueprint. So costs incurred subsequent to occupancy of a purchased building or subsequent to completion of a self-constructed building that either increase the useful life of the building or improve its current state. Now, we will consider normally something as an improvement in which the cost will have to be considered either as a separate, like an improvement, or to be capitalized as cost of the building or the land. For example, for permanent improvement or permanent land improvement. So remember that is to be capitalized as the cost of the land. So in that case, we are going to do that as, again, a separate line item under PPE or a separate account title, or as addition or capitalizable cost as part, again, of the building or the land. So in that case, we are going to do that if there is a benefit in the form of an increase of useful life, for example, or improve the condition. So let's say because of the condition, there were some changes of the economic benefits patterns, and take note, it is an increase, so meaning additional. And that is the case of a capital expenditure versus revenue expenditure, wherein in a revenue expenditure, the state is just the same or lesser. So that's why it will have to be expensed immediately. More of that later. Next, cost of equipment. So we have purchase pricing, handling charges, freight for airplane and ships, then insurance, we've mentioned that already. The necessary special foundations or platform, especially for the assembly and installation or assembling, which of course to support number three to be added. Then the testing and conducting trial runs, because we are still testing if the equipment is ready for its intended condition. And remember our present value for decommissioning and restoration costs for which the entity has a present obligation. Next, for the continuation, then here are the items which are not included as the cost of an equipment. So example in which the relocation of the equipment, however, it has already been ready for its intended use or purpose, or meaning after, so excluded. Remember, only from the purchase up to the time it is ready for use that we are going to capitalize. Next, training personnel who will be using the operations or will be operating the equipment who are responsible. So in that case, guys, we are going to expense immediately, because in that case, it is already after the intended use or purpose of the equipment's establishment. Then number three, cost of dismantling and removing an old is not part, because this is already part of the cost of the old, belonging to the entity prior to the installation of the new. Clearly, that's prior. So in that case, excluded, because again, that's part of the old. Next, what about if we are going to acquire PP items in a lump sum, meaning we are to account for two or more items of PP acquired, then the payment is one form, which is called the lump sum price or the basket price. In that case, we are going to allocate the cost of such particular acquisition to the individual assets based on the relative fair market values at the date of purchase. This is under IFRS 15 or PFRS 15, revenue from contracts with customers. So we just have to develop fractions out of the fair values and we allocate to the asset. So multiply the fractions with the cost. Then demolition costs will be treated depending on the reason. If, for example, an old structure is demolished to make way for the construction of a new building, Therefore, it has to be, or such would have to be considered as part of the cost of the new building. It is because it is for that intention that it is for the construction of the building. So purpose is the key. Then any proceeds from the sale or from sale of salvage materials from the demolition. So example, we destroyed or we demolished the building and we get some scrap materials, we sell such and we get proceeds. In that case, that will be deducted from the demolition cost and will be part of the cost of the new building. Next, if we acquire through exchange, there are also some things that we have to take note. So actually, there are two situations here. If there is commercial substance and there is no commercial substance. If there is commercial substance, it means that it is, of course, with benefit or value to both parties. So commerce is here, which is buy and sell or buying and selling activity. The other is buy, the other is, of course, seller. And that is true also for the other exchange. There's buyer and seller, but there's no essence of doing that for the sake that there is value of each other and there is difference of value between the parties. So in that case, the value of the asset to be incorporated in the books of the company will be based on the order of priority. And if we say priority, if A is not present, then we proceed to B and C. So A is fair value of the asset given up, meaning the asset that we are letting go in exchange of another, plus the payment. So cash paid. And then this is on the part of the acquirer or payer. But then if, example, this is on the part of the receiver or the payee, so in that case, we are going to deduct the cash received. Then B is fair value of asset received. And then letter C is carrying amount of the asset given up plus cash payment. Again, on the part of the payer, but if in the part of the payee, so minus cash received. Now, what if the exchange lacks commercial substance? So in that case, the asset received from the exchange is measured at C. So using letter C, we have to follow that. And normally there is no gain or loss on the situation. So there is no additional value on that perspective for either of the parties. Next, what about if we issue equity instrument or debt instrument? So this is the priority. Fair value of asset received and the fair value of instrument issued. If absent, which is somehow unusual in the case, especially in real life, but then it will be the par value of the instrument issued. That's the third. So for a while, going back, for equity instrument, well, we have the shares, and then the debt instrument is the bonds payable. However, let us take note that it might be different for the debt instrument. So this is true for the equity, wherein we prioritize the fair value of asset received. But for the debt instrument, the first item will be the fair value of the debt instrument issued, followed by our fair value of asset received. And that's how that instrument is unique. Next part or type of acquisition is by donation. In this case, another party or entity donates or gives without additional consideration or peso value in return from us. If the donor is unrelated party, so meaning not part of the group of companies, so that is treated as an income. If an owner or shareholder of a corporation, it will be treated or credited as donated capital, which is part of the share premium under shareholders equity section. Take note, owner or investor or shareholder. That's why shareholders equity. Now, what about if the donor is government? So that will be another item for discussions under government grant. So the basis will be PAS 20. Now, what if unrelated party, but there is a condition. Going back to letter A, it will be treated as a deferred income. So deferred income, which is a liability. Why is that? Because there is a condition. Once the condition is met, so we transfer our deferred income to income. So from liability to income. Then for letter B, this is for a related party, hopefully, as opposed to letter A. Then that's the end of our discussions. Thank you very much for listening, and hopefully you learned something from this session.